Hi, welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. We're talking big themes for 2020, thematic ETFs, ESG, factor-based products. What's going to be hot this year? We have a stellar lineup of ETF experts today, so let's get started. With us is Armando Senra, head of iShares Americas at BlackRock. Jay Jacobs is the head of research and strategy at Global X ETFs. Ed Rosenberg is the head of ETFs at American Century. These are the experts in the whole business. Armando, you run iShares. This is the largest ETF family out there. You've been seeing strong interest in factor investing, investing based on quality, on value, on momentum. Why are we seeing such interest in factors in 2020?
Well, if you look at 2018 was a record year, right? I think that the industry captured about 70 billion in flows. We had about 30 billion in flows. USMV vol that you just mentioned was about 12 billion in flows. Quality was 6 billion, just a record year. And the reason is because investors are using them as instruments of active return, really replacing other active strategies in their portfolios. And it has become an essential building block.
We keep arguing about these factor. Value is the oldest factor out there. It goes back decades and decades. You have one of the big ones, your value ETF, this VLUE. I look at the list here and it's got Intel on it, AT&T, IBM, Micron, Bank of America. It's kind of hard to explain value to a lot of people. In theory, it's book value, revenue, cash earnings. But when you look at it, can you make an argument about why value should be outperforming right now? Is there any particular reason? I get these questions all the time. It's one of the big debates, but it's hard to argue. Value is not outperforming. It hasn't been for a while.
Well, it hasn't been for a while. You're absolutely right. Actually, if anything, in 2020, we think that because of the depressed valuation of value, it could be a good time to start adding in. Now, when you look at the overall suite of USMV vol, quality, they're in the top decile of performance. So the question around whether factors perform or not shouldn't be there. They have been outperforming.
Yeah, it's Intel's the #1 holding in the value fund. It's hard to explain to people why Intel's a value stock, and yet this is how it screens. The answer to this is, why is Intel a value stock? Why is Apple a value stock? It was. Well, that's the way it screens when we set it up. So it's just hard to explain to people sometimes what value is. I want to talk about momentum a little bit because this is a little easier. These are obviously price appreciation over some period. I think the MTUM, your momentum ETF, over the last 6 and 12 months, you kind of split it up a little bit. And here makes it more understandable. Here we have Microsoft and Visa and MasterCard on there and Procter & Gamble. I talk about them every day. You can see the prices going up on that. So momentum is a little easier to explain to people.
Momentum has been on the first quartile in performance, but then you look at USMV vol, and let me give you that as an example. It's not about the period of time that it has outperformed, it's the fact that investors have stayed invested. And ultimately, that's what creates a better investor behavior and better performance for the long term. Yeah. The fact that you stay invested.
Okay, Ed, let me turn to you. American Century also has ETFs with a factor tilt. You've got the Avantis Small Cap Value ETF. That's an actively managed fund out there. You look for things like low valuations, high profitability ratios. Break this down for us a little bit.
Yeah, so if you think of what they're looking for, specifically they're targeting a tilt towards what I would say value and small cap, right? That's the premise, and then they've added in profitability, good profitability for companies long term. So what these are looking at is it's sort of a time-tested process that the gentlemen who run this group have been doing for a really long time. I think they've been at it for like 15 years, and they've been seeing this process. But as you can tell from this environment, right, what that makes you is it makes you a little bit lighter on certain stocks, right? That you had mentioned, similar, like we talked FANG stocks and others previously. All of those make you lighter, and you need sort of that value environment for these products to really play long term. And the bet is long term that they will, because that's where the long term play always seems to be over, the history of, as you said, the oldest factor ever, value.
See, this is the problem I have with factors. I constantly hear people say, well, we look for value and we look, for example, for quality. But quality is a little bit of a nebulous factor overall, don't you think? Can you define quality for us? We hear this word all the time.
Let's think of, there's several ways, and right, all of us are going to have different definitions. But let's start off with the way it's defined as a factor, right? It comes out in a model where it's stock A is what I mean, is better than stock B. Right, that's one way to look at it. The way we look at it at American Century is we look at quality different. We look at the underlying financials and try to determine, is this a stock you would actually want to own? It doesn't matter if it shows up better than stock A or B in some screen. what do the financials look like? How does it look, and does it look good? And is it something that I would want to own going forward?
Yeah. Is there evidence, and guys jump in here, is there evidence that, this is the Warren Buffett method, right? Warren Buffett became famous for buying stuff cheap, but that was high quality. That was sort of the Buffett secret for success. But now with ETFs, is there evidence that if I go look for, say, value and quality, that I'm going to outperform the market? Is there any qualitative even evidence that this method of picking stocks works in the long run?
Yeah, I mean, there's plenty of data out there that goes back 40 years looking at these factors and how they've expressed themselves, but they can still do long periods of underperformance. And that's actually one of the reasons why people think factor performance is so robust, is because it can underperform, and it shakes out the fast money that doesn't believe in value or doesn't believe in momentum, and that's ultimately what drives return in the long run. But what we are saying with investors is don't put all your eggs in one factor. These can underperform individually, they have low correlation to each other, get diversified multi-factor exposure.
But if the problem is, if you diversify, you're still buying the market essentially, ultimately. Armando, is there evidence that investing using these factors really improves your performance? I'm trying to give the viewers some idea of what they should be doing here.
Well,
and I get this question all the time. Why don't I just put it in a index fund? Why should I put it in a momentum fund? Show me that this actually outperforms. Otherwise, you're just confusing me.
Well, I think that, again, a good example of that, for instance, for 2020, we do like quality. And we look at quality in the same way. We look at the stable earnings, we look at low financial leverage. But if you look at US mean vol, I think that gives you the ultimate investor experience, because, you know, when the market draws down 20%, you're down 10%. Over a long time. So you just stay invested, and because you stay invested, you have more chances of outperforming in the long term.
Minimum vol was a big hit last year. You had USMV was the symbol?
USMV.
Yeah, that was a huge hit last year, but only because there was so much turmoil in the market that people went towards, minimum volatility tilts towards consumer staples names, for example. And it would make sense, those kinds of names would underperform higher beta names like technology. So yes, USMV was a big star last year, and you attracted a lot of, look at that chart in the last year, you attracted a lot of interest there, but that would make some sense. I don't know if that makes sense in a long-term investment necessarily. Again, it's tough giving viewers any kind of coherent advice on. Ed, what do you tell people about this? You know what I'm getting at here. What kind of coherent investment advice can you give people?
I mean, look, one, people believe in let's just start with value. People believe in the premise of value, holding it for the long term. If you hold it for the long term, right, it tends to outperform over time. Now here's the hard part. We've been in since, late 2008, early 2009, we've been in a growth environment. And that has sort of waned on the value. It's the longest bull market we've had. And without any of that volatility, which is what value is looking for to outperform over time, it looks like it's always going to underperform. But there will be a cycle that we're getting to, especially if we're at the end of this bull run, where value is going to come into play, and having some in the portfolio is going to be important. Now, if you think of an index, right, what am I overweight most? I'm overweight things like, Apple, Amazon. I'll have more of a Tesla weighting than anything else. These will be significantly underweight in value, which is what's causing the underperformance today. But when those start to fall, is that where I want to be?
Yeah. This is the old value argument. It's been going on for years, and so far it's not working in the last few years. But I want to move on here. I want to talk about another broad theme for 2020, and that's thematic investing. Pot was big last year and it fizzled out. Jay, Global X, you specialize in thematic investing. You've got ETFs for a range of disruptive technologies out there: robotics, cloud computing, electric vehicles, video games, cybersecurity. What's seeing inflows? What are investors putting their money in right now in these thematics?
Well, I think one of the hottest themes right now is cloud computing, and it's, you don't have to listen to us. Look at what the big tech companies are talking about in their earnings. AWS is most of what Amazon's focusing on. IBM is replacing their CEO with the head of their cloud unit. Microsoft, all they want to talk about is Azure and their 60% revenue growth. Google is now breaking out their cloud revenue from the rest of their revenue reporting. So this is a theme that isn't just coming from the ETF industry, this is coming from the technology sector saying our growth is going to come from cloud computing.
And I'm looking at your largest holdings in your cloud computing ETF. That's CLOU is the symbol there. There it is, right up there. Shopify, Paycom, Paylocity. They do payroll software, essentially, Paylocity. Zscaler, I see Netflix here. I don't see Amazon, interestingly, but this is an interesting group here. Again, these are people who are specifically investing in cloud computing infrastructure, essentially.
These are software as a service companies.
Yeah.
So they're being built on top of that cloud infrastructure to deliver software to enterprises who license that software. They pay a recurring revenue, it becomes ingrained in their businesses. It's a very sticky client contract. So we've purposely kind of tilted the exposure of the ETF away from the Amazons and away from the Googles because they're not really pure plays in the cloud computing space. We've tilted it more towards those pure play software as a service companies that are built through the cloud and leveraging that technology.
The other one I see is inflows is robotics and artificial intelligence. The symbol here is BOTZ, bots, clever with that. I see NVIDIA, which is on everything on any kind of this technology list. Mitsubishi, Intuitive Surgical, they do the robotic surgery, right? There's big, fairly large weighting in Intuitive Surgery as well. I like this idea, and it seems to have caught on a little bit. This was one of your big ETFs last year.
Absolutely, and I think this is intuitive with investors. They see that automation is getting more powerful, that companies are investing in robotics, they're investing in bringing in AI systems, but they don't really know where to start. Who are the big robotics companies? A lot of them are in Japan, some of them are in Korea and Germany, so they're not kind of common knowledge to US investors. The ETF, I think, is a perfect example of giving people that exposure to the companies best positioned in the space.
And just as another example of how stuff pops in and out of the public consciousness, you have a genomic ETF. The symbol is GNOM. And one of your holdings in there is GenScript. Now, this is a rather obscure company, but they do the detection kit for coronavirus, right? And that stock has been moving, and it's been moving that ETF. GNOM, again, the symbol there, you're looking at that right there. Tell us about GenScript.
Yeah, so people, I think, have trouble kind of understanding what is genomics, but it's a lot of kind of reading the genetics of people, of diseases, and they use that to create brand new technologies for treating healthcare. So GenScript is making the devices that detect coronavirus in China. Of course, that is playing a critical role right now in, in China and in the global economy as people are trying to understand the spread of that disease.
Good way to show how broad ideas move ETFs, and sometimes individual stocks like Tesla moves these ETFs. They're involved in virtually everything, macro and microeconomics. Armando, you had a big year with your ESG funds last year. You're continuing to see inflows this year. We may see a doubling of ESG assets under management.
Yeah, and it all goes back to, again, last year was an inflection point, the realization that this is not a niche play, this is mainstream, this is going mainstream. This is the understanding that ESG-related risks play a real role in asset pricing and therefore in portfolio construction. We're launching the Advanced Suite later on in the year. And that Advanced Suite of ETFs. That will be the most pure play in ESG, where you'll have high rating ESG companies. At the same time, you have 16 screens. So for instance, fossil fuels, not only you're screening out fossil fuel companies, but the entire value chain. So any company that gets revenue from fossil fuels will be screened out. And again, it's the realization that these are real business risks that have an impact in portfolio, and therefore you have to build your portfolios thinking of ESG risks.
Yeah. It's nice to see inflows into ESG, that's not a surprise, but Ed, what surprised me is the overall inflows this year. We were just talking before the show started, 73 billion in inflows into ETFs this year, bond funds and stock funds overall. That's a tremendous start to the year. We're going to pass $5 trillion in assets under management very quickly at this rate. Besides ESG, last week we saw huge inflows into your boring plain vanilla funds. Your S&P 500 iShares fund had big inflows last week. Investors sort of came back into the business overall. Ed, thoughts on flows here?
I mean, look, ETFs are gaining momentum, and as the landscape shifts and advisors want more and more ETFs, they're going to look to different versions, whether it's thematic or whether it's basic. They're just going to come more into play. I mean, the biggest year we had in ETF flows was about 3 years ago, and the last 2 years were just behind. We've never been off to this start that I've seen, and quite frankly, it looks like we could be in for a great year for all of us. And I think that says a lot for where ETFs not only came from, but where they're headed.
I keep looking at the bond funds, waiting for the yields to sort of back up a little bit and the prices to come down. I keep looking for that, great month where we talk about massive outflows in bond funds, and it never comes. It's been 3 years I've been sitting here waiting for this to happen. And basically everyone has sort of convinced, we've all levitated ourselves into believing this is it, folks. We're going to have lower rates. Europe and Japan seems to want to get positive yields. But not very positive yields. Armando, are you confident we're going to stay rates are going to stay lower for longer?
We do believe rates are staying lower. That's why we're also recommending emerging market debt, high yield as a way to pick up in yield. Again, because we have a moderate constructive view on market risk. What I would say is with bond funds, with fixed income ETFs, what you see is the replacement of bonds for fixed income ETFs. So it's not so much just the market.
Yeah, that's a very good point. All right, guys, we got to go, but that's been a very stimulating discussion. We hit on a lot of topics. These are the experts in the field. It doesn't get any better than this, folks. And that does it for this week's ETF Edge. I'm Bob Pisani. And my thanks to Ed, Jay, and Armando for joining us today. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Wednesday, not Monday, Wednesday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.